నమస్కారం. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయ విద్యార్థులకు స్వాగతం.
Hello friends, today's lesson is on annual value covered under section 22 of the Income Tax Act 1961. This chapter is popularly described as house property. The annual value of a building and land appurtenant thereto, which is being used by the SSC for his own residence, is taxable under this section. The annual value of a building and the land which is also part of the building is covered under this section. The annual value is chosen from or calculated from four values. The values are standard rent, also called as standard rental value, municipal rent, also called as municipal rental value, fair rent, fair rental value is the other name for this, and the fourth one is the actual rental value. You should observe that out of these, the first three are notional values. They are not actual values, they are notional values, and only the last one, the annual rental value, is the real value or real rent received from the house. Now, as you can clearly see, the standard rent is the rent which is fixed by the Rent Control Act, if it is applicable. You can very well observe that cities are mostly congested, and therefore the corporations are likely to pass a standard rent control act so that the rents don't spiral upwards. So standard rent, and if there is no rent control act applicable in the region, the municipal records will have a valuation for the house. That valuation is called as the municipal rental value, and one of these two will be available, the municipal rental value or the standard rental value. One of these will be available in a particular city. In classroom situation, if we come across both, the students may simply complete the calculation by implementing the steps. Now, the other one is the fair rent. As the word itself is suggesting, fair rent is the rent that can be reasonably received on the house in a similar locality. So, we should observe that we cannot compare a very upmarket locality with a down market locality. The houses should be of the same locality. Further, we should compare houses which are of the similar nature, that is, a 2-bedroom apartment should be compared with another 2-bedroom apartment of the same locality. In such a way, we compute the fair rent. So, the computation of annual value for a let out house will be comprising the following steps. The annual value is computed in total 5 steps. The step 1 is comparing MRV and FRV and choosing the higher of the two. Then the second step is comparing the higher figure resulting from the first step with standard rent and picking up the lower of the two. Now, students should observe that if standard rent is not given in the information, then they can directly go to step 3, and step 3 is comparing the result of step 2 with the annual rental value, ARV. Now, here we should spend some time on ARV. ARV is the rent received or receivable as adjusted by unrealized rent. So, you should observe that if a tenant has defaulted the rent, and that is, it is outstanding, we say, no. So, the outstanding rent is also included in the rent. So, let us say a tenant has paid rent for 10 months and 2 months of rent is still pending from him. For computation purposes, rent received for 10 months will be taken, as well as outstanding rent of the 2 months will be taken. The entire amount will be described as ARV. In order to claim unrealized rent, the conditions should be fulfilled that are laid down in the tax law. The conditions are simple. The tenancy should be bona fide, and the defaulting tenant should have been either evicted from the property or either legal steps have been taken to vacate him from the property. these conditions are to be satisfied and proved to the satisfaction of the assessing officer. So if assessing officer is happy with these facts, they will allow the unrealized rent as a deduction. So ARV would be the calculation in the form of rent received plus outstanding rent minus unrealized rent if proved to the satisfaction of the assessing officer. So that ARV will be now compared with the result of step 2. Step 2 result is described as ERV, expected rental value, or also described as reasonable letting value of the house. Now step 4 we describe as vacancy, and vacancy is nothing but the house is not occupied by the tenant. So vacancy, if it is a fact, then proportionate rental value will be deducted in the name of vacancy. For example, if 3 months out of 12 months are vacant, then 3 by 12 would be the proportion for vacancy allowance calculation. And step 5, the last step, would be the result of step 3 minus vacancy would be the gross annual value. Now the computation of house property income is depending on the nature of occupancy. That is, the house could be a let out house or it could be a self occupied house. And please observe that according to section 22 definition, self occupation for business or profession is not covered under section 22, it is covered under business or profession head. So coming back, if it is a self occupied for residence, the calculation would be different, and if the house is let out, the computation would be as per the format that is visible on the screen. So the format goes like this: we compute the gross annual value. From the gross annual value, we deduct the local taxes that are paid by the SSC, and you can observe that if the SSC has not paid the local taxes himself or herself, that deduction is denied. The resulting figure is described as net annual value, NAV. From this net annual value, we now deduct the statutory deduction of 30%, and this statutory deduction of 30% is depending on NAV, and it does not have anything to do with the actual expenses. Irrespective of the actual expenses, it is allowed, and the 30% statutory deduction is meant for taking care of repairs and correction charges and all the expenses that are incurred in relation to the house. So the deduction is not mentioning any particular expense by name or amount. It is simply a statutory deduction which is allowed at the rate of 30% of NAV. And the only other deduction that is available from the rental income is the interest on loan taken for the house property purposes. So you can observe very well that the result from the calculations may be a loss figure, that is, the computation of a let out house may result in a positive income or it may result in a negative income. Now let us go for an example and see how the calculation is done. Now let us say there is a Mr. P who purchased a flat from Mr. Q, and as per the details which are available on the screen, you can observe that the date of transfer is 1/12/2012. Now let us take some figures as facts. Standard rental value being 2700, municipal rental value being 3000, fair rental value being 3300, and monthly rent is 300 per month. With this data, we will now compute the calculations in the hands of Mr. P as well as Mr. Q. Firstly, we will do it in the hands of Mr. Q for the current assessment year. Now the computation goes like this, and please follow the steps on the screen along with me. The computation is like this. Step 1 says that we should compare MRV and FRV. Now MRV is given as 3000 per annum, and here you should also observe one more time, you should observe that the MRV, FRV standard rental values are usually for the complete house and for the complete year. And here in this example, Mr. P is owner for only 8 months of the current previous year, that is from 1/4 to 1/12. So 8 months of the current previous year Mr. Q is the owner, and the remaining 4 months Mr. P is the owner. And let's first take the computation in the hands of Q. So Q is the owner for 8 months. So MRV, FRV and standard rent will all be calculated for 8 months. So please follow the calculation there. That will be MRV is 3000 into 8 by 12, that is 2000. Then FRV will be 3300 into 8 by 12, that is 2200. The higher of these two will be of course 2200. Now we come to step 2, comparing the result of step 1. 2200 is now compared with SRV. So SRV is 2700 into 8 by 12, that is 1800. Now lower of these two is 1800. Obviously this 1800 is described as ERV, expected rental value, also called as reasonable letting value of the house. Now in step 3 we are comparing ERV with ARV. ARV of course is 300 per month into 8 months, that is 2400. So 2400 or 1800, whichever is higher, comes to 2400 as the ARV. And in this case we don't have any vacancy, so step 4 vacancy is nil. Step 5, the gross annual value GAV will be 2400 minus nil, that is 2400. So this is the starting point for computation of a let out house, the gross annual value. From this we deduct the local taxes paid by the SSC. Now in the question we have mentioned that P has not paid the local taxes, but we should observe that we are firstly computing Mr. Q. So Q has paid the local taxes himself. That means 8 months of local taxes will be MRV 2000 into 10% of local taxes, that is 200. So when we deduct 200 from 2400, the result is net annual value of 2200. Statutory deduction of 30% of 2200 comes to 660. So this is a simple example where we have observed that the computation of the house is done depending on the ownership. Now on 1st December the ownership has changed to Mr. P. So in the hands of P, a separate computation is made in the return of income of Mr. P. It is given in the question that the tenant has continued and the rent of the house is still 300 per month. So now please follow the calculation for Mr. P. P is the owner for 4 months, that is 1st December to 31st March of 2013. So 4 months calculations will be made, MRV, FRV, everything will be calculated for 4 months. So MRV is 3000 into 4 by 12, that is 1000. FRV is 3300 into 4 by 12, that is 1100. So higher of the two comes to 1100, that is the result of step 1. Now we go to step 2. In step 2 we compare 1100 with standard rent, that is 2700 into 4 by 12 comes to 900. So 900 or 1100, whichever is lower, the 900 will be the result of step 2 ERV. Now in step 3 we compare ERV 900 with ARV, and ARV of course is 300 per month into 4 months, that is 1200. So the final computation for GAV comes to 1200, and after this we continue with the remaining part of the format, less local taxes paid by the SSC. But it is mentioned in the question that P has not paid the local taxes, so it is not allowed as a deduction to the SSC. So NAV is also 1200, 30% for standard deduction, and that comes to 360. So the balance 840 rupees is the income from house property accessible in the hands of Mr. P. So this example highlights the couple of things, that MRV, FRV, SRV are usually for annual basis, that is for complete year, and depending on the period of ownership they should be calculated. And local taxes also are allowed only if they are paid by the SSC themselves, otherwise they would not be allowed as a deduction. Now let's further discuss about the annual value in the case of a self-occupied house. Now self-occupation obviously implies that the SSC is occupying the house for the family purpose, residence purpose. Because if self-occupation is for the own business of the SSC, it is covered under section 28 business or profession chapter. It is not covered under section 22. Now section 23 further says that where an SSC is claiming a house as self-occupied, the annual value shall be taken as nil. So clearly you should observe that in the case of a let out house, annual value is the result of comparison of 3 notional values, MRV, FRV, SRV. But in the case of a self-occupied house, all such calculation is not necessary. Simply the law has given the benefit to the SSC that the SSC can claim the annual value as nil. Now from this annual value only one deduction is allowed, that is in the name of interest on loan taken for the house property purpose. This house property purpose is a very wide term, as you can see. Suppose there is an SSC who has house X and house Y. Suppose he has mortgaged house X and used the money for constructing house Y. So the loan is meant for house Y, therefore the interest is deductible in the computation of house Y. That is what you should observe. That is the simple meaning of for the purpose of the house. So loan for the house and not loan on the house, that is how you should observe. So in the case of a self-occupied house, the SSC will be given the benefit of claiming the annual value as nil, and from that zero value a further deduction is available in the form of interest on loan up to a maximum of 1,50,000 rupees, and this limit of 1,50,000 rupees is applicable for loans taken on or after 1/4/1999. For any loan which was taken before 1/4/1999, the interest is allowed only to the extent of 30,000. Of course, the amendment has been made in such a way that any loan taken for the purpose of a house before the house itself was constructed before 1/4/99, but a further loan was taken after 1/4/99 for the purpose of repairs, renewals. In that case, the interest is available up to 1,50,000. So you should observe that for a house which is purchased or constructed after 1/4/99, the limit is 1,50,000 without any restrictions. Now let us understand the computation of self-occupied house with a simple example. Let us say there is an SSC who is a salaried person with a computed salary income of 3 lakhs, and obviously the scope of this lesson does not cover salary, so we take computed salary income as 3 lakhs, and the house itself was purchased some time ago, say 2007-8, some such thing. Now during the current year, the SSC is having the house under self-occupation, and the interest part of the EMI schedule, you can see from the example that is there, the interest part is given as per the EMI schedule. Now the computation of the house is as simple as this. The annual value under section 23 will be taken as nil. From this annual value, the only deduction that is available is interest on loan, but the interest on loan is exceeding 1,50,000, as you can very well see from the data there. So the maximum deduction is limited to 1,50,000, and from zero value, if 1,50,000 is deducted, it results in a negative value. So students must observe that a self-occupied house computation, it will be either 0 or negative. If the SSC is able to claim any interest expenditure, the annual value would be negative, otherwise it is a 0 figure. Whereas to compare, in the case of a let out house, the result from the let out house could be positive, that is taxable income, or it could be negative, whereas in the case of a self-occupied house, the computed figure would be either 0 or negative. And you can see the computation that the negative figure of 1,50,000 is then finally set off against the positive income of salary income rupees 3 lakhs, thereby resulting in a gross total income of 1.5 lakhs. So which brings us to the point that what to do if there is a loss from the house property. The loss from house property can be set off against other heads of income during the current previous year itself. We must observe that there are in total 5 heads, so the house property loss can be set off against any of the other 4 heads. Then after such set off, if there is any loss still remaining, such loss is allowed to be carried forward into for future years. So such carry forward is allowed to a maximum of 8 years, and the loss can be carried forward and set off against income from house property only. Now coming back to self-occupation, there are a couple of points that we should observe. Sometimes it may so happen that the SSC owns a house or a flat, but SSC is unable to occupy the house because of the business or profession or employment. And now these days cities are so big that the office area may be 20-25 kilometers away from the residence, so it would be a lot of trouble to commute. So these are some of the circumstances which the income tax law has also recognized. Now the SSC can claim self-occupation from the house even though the house is not self-occupied, provided the house is under lock and key and the SSC does not get any other benefit from the house. So this is a gesture on part of the government where SSC is unable to self-occupy the only house that they own. Further there is another situation which is also covered by the income tax law. sometimes SSE is owner of 2 or more house properties. Now, and all of them are under self occupation, then the law says that the SSE can choose one out of these houses as self occupied, and once the choice is exercised, the other houses will be deemed to be let out. The computation of deemed to be let out houses are exactly same as a let out house property. The only fact is that the vacancy allowance should not be allowed, because the vacancy allowance is available only for a purely let out house. Suppose SSE has 3 houses, let's call them as ABC. Now, which one of these to claim as self occupied? It is a pure matter of combinations. The SSE should take out combinations, let's say A as self occupied, B and C as let out, B as self occupied, A and C as let out. In this way, combinations have to be taken out, and the computation of gross total income of each combination will be worked out, and that combination which results in the least GTI will be the one that the SSE chooses. That is, as a tax planning, SSE can choose one of the house as a self occupied house. Now, there is one more thing to be observed regarding let out houses. To go back to let out houses, let us talk about situations where the house is partly let out and partly self occupied. So this is the third situation that we are talking about. Situation 1 would be a purely let out house. Situation 2 would be a purely self occupied house. Now we talk about a situation where a house is partly let out and partly self occupied. This could be in 2 ways. Sometimes the house is containing units. What is a unit of house? It is that which can be let out separately, independently, without any common facilities such as common toilets in that way. So a house contains parts, each part is separately let out. Then the part of the house is described as a unit of the house, and the unit of the house is calculated as if it is a separate house. For example, the SSE has a house containing 4 units. One of them the SSE is self occupying, the other 3 has been let out. So the computation for 4 units would be done as if there are 4 houses, and all expenses such as local taxes and interest on loan would be taken proportionately. Suppose one unit is occupying 40% of the floor area, so the 40% of the local taxes, 40% of the interest on loan taken for the house would be considered in the calculation of the 40% floor area. Of course, as students would remember that MRV, FRV, these are for the full house and for the full year. So in this 40% computation situation, MRV, FRV, SRV would also be obviously taken at 40%. There is one other situation where the house would be occupied by the owner for a certain period and let out for a certain period, and periods of occupancy and periods of let out need not be in any order. Now the computation of this house would be done just like a let out house, disregarding the period of let out completely. Suppose a SSE has occupied the house for about 8 months, then the SSE was transferred to another city, and the house was let out for the 4 months, but the computation of this house would be done as if the house is let out for the complete year.
మా కార్యక్రమాలపై మీ సూచనలు సలహాలు తెలియజేయండి. మీ సూచనలు సలహాలు తెలియజేయవలసిన చిరునామా: డైరెక్టర్, ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్, డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ, ప్రొఫెసర్ జి రామరెడ్డి మార్గ్, రోడ్ నంబర్ 46, జూబ్లీ హిల్స్, హైదరాబాద్ 500033.